This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 255, 401k questions. We're recording this on March 8th. It's going to run on March 24th. Welcome back to the podcast. It's been a really fun time here at the White Coat Investor the last few weeks. We've been wrapping up from our conference. The conference turned out spectacularly. If you haven't taken a look at that content that's available as an online course, be sure to check that out. And of course, it's awesome because it's not only got a ton of financial material, but it's got a bunch of wellness material too. And at the end of the pandemic, that's something all of us kind of need. I mean, if you haven't been feeling the stress in the last couple of years, consider yourself lucky. Every time I look at a survey, it seems like doctor burnout has gone up by 10 or even 20% over the course of the pandemic. So if no one said thanks, let me at least tell you thanks for what you do. Let's have a word from our sponsor. StudentLoanAdvice.com is a white coat investor company created to help doctors, dentists, and other high earners tackle and defeat their student debt. Letting a professional guide you through the best options to manage your loans will save you hours of research and stress and potentially save hundreds to thousands of dollars with your custom student loan plan. Book a consult with a student loan consultant at StudentLoanAdvice.com today. Not only does that get your stuff reviewed, but you also get to spend an hour with a student loan consultant, and perhaps most importantly, you get 6 months of free email questions afterward, which is a great resource to have to continue to make sure you got your plan going the way it should. All right, we got lots of questions from you guys today. We're going to get on the speak pipe and listen to some of them. Here's our first one, talking about the IRA rollovers.
Good morning, Dr. Dolly. I have a question I hope you can answer. I sold my practice serendipitously just before the pandemic lockdown and transferred my 401k and cash balance money into my traditional IRA. My new employer does not offer me a 401k option for this year, and I prefer to self-direct anyway. I would like to get that retirement money back into a 401k for possible enhanced asset protection. I live in Pennsylvania, as well as avoidance of UBIT and leveraged debt funds. I'm the manager of an LLC through which I invest in commercial equity real estate deals. Could I open a solo 401k for myself in the name of that LLC and roll my IRA money into it? Thanks for all that you do.
Okay, there's a lot in this question that we need to cover. For example, when you leave an employer, you probably don't want to roll your money into an IRA. Now, laws could change at any time, and maybe this won't be so bad for doctors to do later, but for the most part, you don't want to do that. And the reason why is because it keeps you from being able to do the Backdoor Roth IRA process each year. When you have money sitting in a traditional IRA, it messes up that process in that the conversion step becomes prorated, and you don't want that to happen. So as a general rule, if you're leaving a company, they'll tell you you can roll over your money into an IRA. And a lot of people giving money advice out there that is not doctor specific will tell you go ahead and do that. And that's not necessarily great advice for doctors, not only for potential asset protection concerns, but also just because it messes up your backdoor Roth IRA. What should you do instead? Usually leave the money in the 401k there until you have another one available to you, whether it's at a new job, whether it's a solo 401k, whatever. So in general, try not to do that if you're in this situation. You can avoid having this dilemma. In this case, the doc is hoping to get a few other advantages out of it. He didn't even mention the backdoor Roth IRA. Maybe he doesn't care. Maybe he's got some other IRA out there that's going to keep him from doing a backdoor Roth IRA. Maybe he doesn't know about the backdoor Roth IRA. I don't know, but that was the first thing I thought about when I hear an IRA rollover issue. Okay, so let's first talk about this asset protection that he thinks he's going to get in Pennsylvania from having his money in a solo 401k instead of an IRA. That's pretty much bunk. Okay, if you look up Pennsylvania asset protection law, what you will find is that IRAs are basically 100% protected by the state, except for amounts contributed in the previous year or more than $15,000 contributed in a single year. Okay, so that's issue number one, is the IRA shouldn't be an issue. right? So if you're just looking for asset protection, the IRA does just fine in Pennsylvania. Two, keep in mind that solo 401ks are not necessarily put in the same category as an employer-provided 401k as far as ERISA goes and as far as your asset protection goes. Okay, a regular, real 401k enjoys 100% federal asset protection. That's not always the case for a solo 401k. You may get a little bit less. It may be the equivalent of the IRA protection in your state. So keep that in mind as well. What it does do, however, having your money in a 401k, particularly a self-directed 401k that you want to invest in real estate, is it allows you to avoid UBIT, okay, which is basically a tax that applies in IRAs, but it does not apply in 401ks. And so that's why if you can put the asset in a 401k, then you can save that tax. All right. So UBIT, let me pull it up here. I can always forget what it stands for. Unrelated Business Income Tax is what it stands for. And basically, if you have leveraged equity real estate in an IRA, you may end up paying this tax. If it's in a 401k, you don't pay it. So it's basically an avoidable tax. And that's why he's interested in getting the money into a 401k. And that makes sense for his purposes. Personally, I think it's worthwhile just having, your debt real estate inside retirement accounts and putting equity real estate just in a regular taxable account. A lot of that income is generally sheltered by depreciation. Set up properly, a lot of times you get many years of basically untaxed income from that property. You can depreciate, exchange, depreciate, and die, and your heirs get a step up in basis, and nobody ever pays that depreciation back, much less any capital gains. And so I generally, not a huge fan of putting equity real estate into IRAs or 401ks. If it's the only money you have, then it can make sense. And obviously, there are the IRA and 401k tax benefits of having it in there. But if you're going to have stocks and bonds in your portfolio anyway, and you have a taxable account anyway, then it can make a lot of sense to just have the equity real estate be outside the 401ks. Okay, here's the bigger issue, though. In order to have a 401k, remember, this is a retirement plan. You can only put earned income into a retirement plan. You cannot start an LLC, invest it in a bunch of stocks or in a bunch of real estate and call that earned income. It's not earned income. It's rental income. It's portfolio income, whatever you want to call it, unearned income, but it's not earned income. That's why you don't have to pay Social Security and Medicare tax on it. That's also why you can't use it to contribute to a solo 401k. Now, you don't have to have much of a company to open a solo 401k from it, right? I mean, if you're taking surveys, that's probably enough. Now, some people argue about this, that you got to have regular income and have plans to make a profit and to be in business long term in order to do this. But practically speaking, nobody is looking at how long you're in business. There's no requirement of how much income you have to earn in order to be a business and in order to open a solo 401k for that business. Now, if you don't make much in your business, you're not going to be able to contribute much to the solo 401k. But that's not the purpose here. The purpose here is to facilitate an IRA rollover. So even if you can't contribute anything new to it, you still have the ability to roll hundreds of thousands of dollars into it from your IRA and then be able to invest that in equity real estate and not have to pay UBIT or UBIT tax. So that's your bigger issue is no, this LLC that all it's doing is investing in commercial real estate isn't providing you any earned income unless you're somehow, doing something more where it's actually an earned income kind of situation. Maybe you can justify it if you're doing short-term rentals in it, for example. But just classic, real estate investing, whether you're doing syndications and funds or whether you're investing directly, that's not earned income. That's good because it saves you the payroll taxes. It's bad because it doesn't allow you to contribute to a 401k. Hope that's helpful, and good luck with figuring out where you want to go with this moving forward. All right, let's do our quote of the day. This is from Henry David Thoreau. Success usually comes to those who are too busy to be looking for it. I think there's a lot of truth to that. Most of the successful people I know aren't out there chasing success. They're out there trying to do something else with their lives and accomplish some of the other goal, some other passion or vision that they may have. All right, let's take another question about a 401k off the speak pipe.
What is the difference between a 401k and a 401cu? And is a CU bad?
All right, this one's a little bit of a tricky question. I actually get questions like this all the time. A 401cu is nothing that I know of. Google returns nothing for that search string that has any meaningful anything. 401c is a section of the Internal Revenue Code. Okay, not to be confused with 501c3s, which are nonprofits, but 401c just refers to a qualified pension or profit sharing or stock bonus plan. And so that's the section of the Internal Revenue Code. But a 401cu is not any type of a retirement plan that I know of. Now, keep in mind that lots of different companies call plans by different names. And the commonly used names, which are often these numbers, 401, 403, 457, is not necessarily what they call your plan that is one of those things. And so maybe you're confused, maybe they're calling your plan by something weird, but you just got to go in there, talk to HR, get the plan document, figure out what kind of plan this is. But a lot of times for a doc, it's some sort of 401k combined with a profit sharing plan, that sort of a thing. And so you just got to go in and get the plan document and figure out what these options are that are available to you from your employer, and really understand what you can do with it, how much you can contribute to it, what the methods are that you can use to get the money out, what you can invest it in, how much control you have over it, what kind of a match they're going to put in on it. But I think you're going to find all the information you're looking for in that plan document. Hope that's helpful. All right, my next question comes in from an emailer. I wanted to ask a question for your podcast or blog about setting up a specific solo 401k. My wife and I started our first short-term rental that is titled in a Wyoming LLC for asset protection. We also did a cost segregation analysis and will take 100% bonus depreciation for 2021. So we will have a large tax write-off this year. In the next years, we would like to put the money we get from the short-term rentals into a solo 401k as a tax shelter. Is that something we can do? And if so, what do we need to do to set one up? Are there specific brokerage accounts, E-Trade, Fidelity, etc., that allow this? We anticipate getting between $50,000 to $80,000, so it would be nice if we could find a way to tax shelter it. My wife works part-time for a place that does not offer her a 401k, so we would like to put as much of the profit into that account as we can. Keep in mind, if your wife's business does not offer a 401k, a traditional IRA is actually deductible to her. That would be an option if she doesn't just want to do what we usually do in the white coat investor world, which is a backdoor Roth IRA. But if that goes away for some reason, that is an option for her to have a traditional IRA. But anyway, the point here is most of the time, rental income is not eligible to go into a retirement account of any kind. It's not earned income. You don't pay Social Security tax or Medicare tax on it, and you can't use it for retirement account contributions. However, when you are running a short-term rental, it's not exactly the same thing. You're really in the hotel business, and it's far more active income, right? Because you're having to do all these things. And so certainly at least a portion of that money should be considered earned income. That, of course, has pluses and minuses, right? The minus is you pay payroll taxes on it, especially if you haven't already maxed out your Social Security tax. That's a not insignificant amount of tax. The plus, of course, you can use it to make retirement account contributions. You can open up a solo 401k just about anywhere. You can go to Vanguard, Fidelity, E-Trade, etc. That's no big deal, right? You fill out 10 or 15 pages of paperwork, you send it back to them. Within a few weeks, they've opened a solo 401k for you. Don't wait till December to do this because you need to establish it during the calendar year. You don't get all kinds of time after the end of the year like you do with an IRA or a SEP IRA. But it's pretty easy to do. It just takes a few weeks. The real question that you've got to determine, though, is whether that money is earned income or not. And for a long-term rental, it definitely isn't. For a short-term rental, it's much easier to justify, especially if you're doing the booking, managing, cleaning, etc. yourself. And so, I found a nice blog post from markjkohler.com that talks about, the taxability of these sorts of short-term vacation rentals. And he says, if you either don't stay on the property at all or rent it out at market rates for more than 14 days in a year, then the income from your short-term rental is undoubtedly taxable, right? Remember, you can rent something out that you own for 14 days a year, and you don't have to pay tax on it at all. That's a really great deal. For example, we rent our house to the white coat investor for 14 days a year, and that actually works out way better for us than the home office deduction does. So keep that in mind if it's, kind of a vacation property that you just rent out a little bit. But assuming you're doing that, you're renting it more than 14 days a year, it really comes down to whether it's passive rental income, which gets reported on Schedule E, or active business income, which is reported on Schedule C. And the answer to that depends on whether you provide substantial services to your guests, not just a nice place to stay. But when you're providing substantial services to them, then the income you make needs to be reported on a Schedule C and is subject to self-employment taxes. So examples of services that would be considered substantial are cleaning to the rental each day while the property is occupied by the same guests, changing bed sheets and other linens each day while the property is occupied by the same guests, concierge services, conducting guest tours and outings, providing meals and entertainment, like a bed and breakfast. If you're providing breakfast every morning, right? It's kind of active income. Providing transportation, providing other hotel-like services. So the more you look like a hotel or a true bed and breakfast, the better the chance that you'll need to report your income from the rental on a Schedule C, pay self-employment taxes on it, and you can contribute to a retirement account for it. But if you're not doing any of that other stuff, if it doesn't look like a hotel what you're doing, even if it's short term, maybe it still goes on Schedule E. It's not earned income. You don't pay payroll taxes, and you can't use that money to contribute to a 401k, etc. So, there's pluses and minuses either way. I think the situation for most people, even if they're doing the cleaning after the guests move out, even if they're doing the booking, maybe that's not quite enough to be substantial services, and you put it on Schedule E, and you don't get the 401k for it. I don't know that the IRS cares all that much. They get money either way. You get a benefit either way, whether you're skipping out on those payroll taxes, or whether you're getting the benefit of being able to use a 401k. Maybe it's sixes when you put it all together. All right, our next question comes from John. This one's about, again, 401ks, but also about side hustles. Let's take a listen off the speak pipe.
Hello, Jim. This is John. I have some questions on side hustles and solo 401ks. Number one, at what income for a side hustle does one need to pay quarterly taxes? I've looked everywhere and cannot find a good answer. Number two, assuming that I'm maxing out the employee contribution of my 401k through my W-2 employer, how much can I put into my solo 401k under the employer contribution? Number three, when would you recommend making these employer solo 140k contributions? Should I do them quarterly, at the end of the year, or at some other time? Number four, finally, how do I even make these solo 401k contributions? Is it a simple business account transfer to my solo 401k, or are there some special forms that I need to fill out? Thanks for all you do.
All right, great questions. Let's take them one at a time. The first one is, at what income do you need to do quarterly estimated tax payments? And the reason you can't find an answer is there is no answer. Basically, it comes down to being in the safe harbor. You got to pay enough tax during the year that you're in the safe harbor, or else you'll end up having to pay not just any taxes you owe at the end of the year, but penalties and potentially interest. Okay, so you got to get into what's called the safe harbor. Now, the safe harbor, there's several different variations of it. One way you can get into it is by owing less than $1,000. If you owe less than $1,000 in tax in April, you're in the safe harbor. You don't have to pay any. Okay. Number two, you've got to pay at least 110% of what you paid last year. That's another way to be in the safe harbor. So it's only 100% for low earners. For most docs, listen to this podcast, it's 110%. So you take what your tax due last year was, you multiply it by 110%, you divide it by 4, there's your quarterly estimated payments. But that assumes that you don't have any sort of a W-2 job withholding money. Okay, because the truth is, at the end of the year, you add this together, what you're having withheld and what you send in as quarterly estimated payments. And you might be able to, if you're not making that much at the side hustle, you might be able to just turn your exemptions that you report on your W-4, is that what they're called these days? Whatever they're called right now. You turn them down to zero, so they're withholding as little as possible, withholding as much as possible from your W-2 paychecks. Then you might be able to get enough withheld that you don't have to do quarterly estimated payments at all, that you're in the safe harbor for all your income just from withholdings from your W-2 job. And so that's a pretty easy way to do it if it's a relatively minor side gig. If it's a big side gig, that's not going to work out. You're going to have to make estimated quarterly payments. Now, the fun thing about this is the IRS doesn't look at when money is withheld from paychecks. If you have it all withheld in December, that's just like you had it withheld throughout the entire rest of the year. That is not the case, however, with quarterly estimated payments. They like to see you making even quarterly estimated payments throughout the year. That's probably the easiest way to do it, but it does cause some cash flow issues for lots of people, especially if the business is not earning evenly throughout the year. Like white coat investor income, right? It ebbs and flows throughout the year. Sometimes we have lots of income in one month, other months we might not have a lot of income. And so there is a way you can, pay as you go. And that's basically the federal income tax system is a pay as you go system. And if you don't make much money in the first quarter, you don't pay much in the first quarter. If you make more in the second quarter, you pay more in the second quarter. And there's a form you submit with your taxes that basically shows that. But it's easier not to do that and just pay the same amount each quarter if you can possibly estimate that to be enough to be in the safe harbor. But it's a tricky thing. Those of us who are self-employed, we're constantly monkeying with this, constantly trying to figure out what the right amount is. Even this year, I haven't even done my taxes for 2021 yet, and I'm having to make quarterly estimated payments for 22. So I can't even calculate out what my quarterly estimated payments have to be in the safe harbor. And remember, all of that has nothing to do with how much tax you may owe, right? You may have to write a check for $500,000 in taxes at the end of the year if your business did really well. Even though you're in a safe harbor, you still got to write a huge check. So you want to make sure you have the money available to write that you actually owe on your taxes. So keep that in mind. Hope that's helpful. There's not an income, but basically if it's a sizable side gig, I'd say more than about 10% of what you're making at your regular job, I'd probably plan on paying quarterly estimated payments. They give you a little bit of a break the first year, but after that, they're not very merciful on these at all. So make sure you're paying them. Okay, how much can go into a solo 401k as an employer contribution? If you've used your maximum employee contribution, which is $20,500 for those of us under 50 this year, then all you can put in is the employer contribution, which is essentially 20%. 20% of your net income. That's net of all your business expenses, including the employer half of your payroll taxes like Social Security and Medicare tax. Okay, 20% of that. Third question, when do you make those contributions? Well, you can make them whenever you want throughout the year. If you're not sure how much you're going to be able to put in there, then you might want to wait until about the time you're doing your taxes to at least do the last contribution so you can adjust it as needed. But you could put it in there on January 3rd. If you know you're going to be able to max it out, you could put it in there really early in the year. Again, it's supposed to be a kind of pay-as-you-go system, but the IRS is not watching if you want to max that thing out in January. I can tell you that from personal experience. Nobody sends you any letters or anything about whether you'd actually earned that much that year or not. So you can put it in there anytime you want, but if you're not making a ton of money in the side gig, you want to be careful not to over contribute, which means your last contribution probably doesn't go in until pretty late in the year, or maybe even into the next year before you file your taxes. Remember, the employer contribution, you get a little more time to get it in there. And finally, how do you make them? Well, it depends on the solo 401k. At Vanguard, they have a separate Vanguard site for the employers. You log in, you go in there and you mark, this is employee contribution, this is employer contribution, it's for 2021, it's for 2022, whatever. And then the money gets sent in there from your bank account, and it shows up in the solo 401k, which you see not on that side, not on the employer site, but on the regular Vanguard site when you log in. But it's probably a little bit different at Fidelity, probably a little different at Schwab, wherever you open your solo 401k. Hope that's helpful. All right, we've got another question off the speak pipe about after-tax 401k contributions. Let's take a listen.
Hi, thanks for all you do and keeping us up to date on the mega backdoor Roth. If the mega backdoor Roth does go away eventually, which seems likely, do you think there's going to be any benefit at all to the after-tax 401k contributions? For example, since there's no early withdrawal penalty, it doesn't seem like the worst emergency fund, particularly for someone who might be undisciplined and/or may not be in the absolute highest tax bracket. Thanks.
Great question. You're right that if you withdraw the contributions, the after-tax contributions themselves, that there is no tax or penalty due on that. But all the earnings that contribution may gain are subject to the 10% penalty for early withdrawals, as well as any taxes. So keep that in mind. Would it work for an emergency fund? Well, I guess if you left it in cash or something very not aggressive. But the issue is with an emergency fund, it's more about the return of your principal than the return on your principal. And so I suppose that would be one use for it. It also likely provides significant asset protection, being inside a 401k. So that's another benefit of it. But really what we're talking about here, if, heaven forbid, the ability to convert those after-tax contributions went away, which I don't know if that's likely or not. That tax bill doesn't seem like it's going anywhere right now as I record this in March. But if that goes away, that's obviously the best use of after-tax contributions, to immediately convert them to a Roth. But even if it goes away, there are other things that can happen. You can leave the employer, for instance, isolate the basis and convert it to a Roth IRA yourself, if that's still permitted. Maybe the law changes back in a few years and you can do conversions at that point. But if you are talking about truthfully long-term investing in an after-tax 401k, it's just like non-deductible IRA contributions. Over a certain period of time, decades, the tax-protected growth becomes worth more than the fact that the withdrawals are subject to ordinary income tax rates rather than capital gains rates. So you can be better off investing after-tax money in a 401k or IRA than in a taxable account, especially if it's not a very tax-efficient investment. But over time, the tax-protected growth can make up for the additional tax at withdrawal time. So it's possible this could still be part of your plan. But the best option, of course, is just to do a mega backdoor Roth IRA with it for as long as that is permitted. All right, we're going to have an interview now with Joe Ollis. Let's get him on the line here. All right. I want to welcome a special guest back to the White Coat Investor Podcast. This is Joe Ollis. He is the Chief Investment Officer for one of our real estate investing partners, the Peak Housing REIT. Welcome back to the podcast, Joe.
Thank you. It's great to be here with everybody at the White Coat Investor.
Now, we should warn people that we're recording this on February 2nd. This isn't going to be live on the podcast for a few weeks. So if any of the data seems a little bit stale because something crazy happened in the markets in the last 6 weeks, then that's why, because we recorded this at the very beginning of February. But it's been a pretty crazy year so far in the markets. The last 3 months, cryptocurrencies down 50%. Stocks were down over 10% at one point year to date during January. And it's got a lot of people thinking, wow, do I have to deal with that sort of volatility? What other kind of investments are there out there that provide solid returns that don't make me so queasy? And a lot of them turn to real estate. They turn to single family homes, which is what the Peak Housing REIT specializes in. We were talking before we went on air that there's some interesting data out of fourth quarter of 2021 about single family homes. You want to tell us a little bit more about that?
Yeah, well, it's great to be back, Jim. And you're exactly right. I think one of the key aspects of investing in real estate is the stability it provides. And especially when investors start to think about the day-to-day volatility of the stock market, being able to look at your portfolio of real estate and knowing that those values are staying pretty constant helps out a lot. Single-family rental homes as an industry has continued to just completely take off, both from the aspect of the amount of institutional investors that are coming into it, but also investors like white coat investors. And that's really helped support the single family values of these homes. but also really kind of create a great investment opportunity for investors to join us while it's still early in this game.
It's interesting. I'm in the Salt Lake Valley, which I think they just said we're like second fastest growing housing prices in the country, right behind Boise or something.
Yeah.
And so I think a lot of the, at least price increase for single family homes has been the housing crunch, particularly in places where people are moving, like Idaho and Utah and Arizona and Texas and places like that. Because you're sharing this market. You're sharing it not just with investors, but you're sharing with people looking for a place to live. And how much
Yeah.
of that do you think impacts the rates of return that investors in this space see?
Yeah, that's a really good question. So you're right. I think the analysis that has come out from the last year is that about 17% of single family homes were purchased by institutional investors for the purpose of being a rental home. So it's still a pretty small percentage in the total scheme of things, but it is definitely starting to show that there's more competition. And because of the supply constraints, which have just continued in the last year, I think this is going to continue for quite a bit longer. And when I think about supply constraints, if you really reflect back the previous year, every time there was a supply shortage or a commodity price increase, like if you think about lumber just exploding higher for a period of time last May, that led to builders just slowing down production of new housing, which is further constraining supply. And we're really not even feeling that yet. And that's just going to continue for multiple years.
Yeah, it makes the existing homes more valuable when it costs so much more to make a new home.
It does. It
Yeah.
does. Yeah.
Yeah, I had a call with the insurance company that insures my home, and they wanted to go over everything again because the cost of replacing the home has gone up so much. We actually had to go through the whole insurance process again, which I thought was pretty interesting. But you're right. I mean, in places like Salt Lake, especially a little bit like the Bay Area, it becomes constrained by geography.
Yeah.
And but even in other places, it's constrained by supply. And you're right, with everything sitting on ships in off of the port of LA, it's a little bit harder to get the materials you need to buy a home, and makes the ones that are selling that much more valuable. So a real tailwind, particularly in single family rental homes. Um, a lot of real estate investments are industrial or retail or multifamily. I think is particularly popular, especially among white coat investors. But
Yeah.
single family is this great space that's been hard for people to get into. Why do you think it's been so hard up until the last few years for funds, REITs, institutional investors to get into this space? What's changed that now they're all going for it?
Yeah, that's a really good question. So I'd like to kind of even back up further than that and really look at even multifamily apartment complexes. Clear back in the 1980s, those were really primarily owned by what we call like the smaller investor or even the mom and pop investor. That shift where institutions, which are like the Blackstones and the pensions of the world, they now own 95% plus of all apartment complexes. So that shift took about 30 years. That shift just began in 2011 with the single family rental market. So today, about like 95% of all single family rental homes are really owned by smaller investors, people who might own 1 to 5 homes. Institutions started to step into this because they realized a few things. One, tenants of single family rental homes are really sticky. They want to be in the home. They're raising their family in these homes. They're choosing to be renters. They can't afford the neighborhood, but they really like the neighborhood. All very good reasons for them to be in these homes. That stickiness is a really attractive investment return for all investors. But then what really changed the equation for institutions and for this whole industry is the inclusion of a lot of technologies making it easier to manage what we refer to as scattered site homes. So if you think about like a multifamily apartment complex, you can have 100 homes in just a single area. It's really easy to manage everything when it's just 100 homes under one roof. To manage 100 homes that are scattered throughout a city, it takes a lot more infrastructure. And there's just been so much innovation in technology that allows for the economics of that management to come down in cost. And the example I'd love to give is we use a door lock service called Rently. And what that does is it allows us to essentially have remote access to locks. So we never have to go and change a lock when a tenant leaves a door. That's a really powerful savings tool. But it's even better because from a scattered site portfolio perspective, if we need to send a plumber out to that house, we can actually arrange with the tenant, have the tenant talk with the plumber to arrange a time, and then we can remotely unlock the door without having to send a property manager out there. So just that one little savings is just a prime example of where we've seen a lot of innovation.
Yeah, there's certainly it's never been a very efficient market, and so technology and just innovation can make a lot of new efficiencies there for sure. So the it sounds to me like there's been a lot of interest among white coat investors for the peak housing REIT. What kind of interest are you guys seeing on your end?
Yeah, no, it has been a lot of interest. So I'm a data guy. I'm just total data nerd here. I'm just going to give you today's numbers. We have 62 investors from White Coat Investor who, when they signed up and invested with us, they actually marked themselves as White Coat investors. That's fantastic. That's nearly $3 million of investment. And so we're really excited to embrace this network. The list of questions that come through from White Coat investors really show the level of diligence and intelligence that your investors have. And that means a lot to us. We look at this as a partnership with our investors. And we love it that when people align both with the vision of what we're trying to do, the tailwinds of single family rentals, and then, of course, to invest right alongside us. So it's been a great response.
Yeah, I think there's three things that particularly make the peak housing REIT attractive to our folks. The first is just the opportunity to do single family homes. The vast majority of people we partnered with aren't in the single family home space. The second, though, is the relatively low minimum investment. Now, $25,000 is still a lot of money, but it's dramatically less than the minimum investment with a number of funds out there. And so it gives people a chance to it's not quite try before you buy, but it's try for a little bit of money before you put a lot of money in. And so they can get in. Doctors can afford that. That's a typical 1 month salary kind of amount for a doctor, and that allows them to see it and watch it and see how it goes. And if they're like most investors, they end up investing more later over time. So I think the minimum's pretty attractive. And the other thing that a lot of people have commented to me about is that they like the idea that it is a REIT and they're just getting a 1099, that they're not going to get a K1 and have to file in 8 states from it. And I think that's really attractive. Once somebody has a few private real estate investments and has had to go hire now somebody to do their taxes because they got 12 K1s in 8 different states, all of a sudden, just the REIT tax structure becomes much more attractive to them.
Yeah, that is definitely true. And I think as our investors will see, we're expanding our REIT into multiple different states in the next year. And so that will become even more important as a tax strategy. That 1099 is much more favorable.
Yeah. All right. So if you want to learn more information about the Peak Group, about the Peak Housing REIT, the easiest way to do that is to go to whitecoatinvestor.com/peak. That's PEAK. And you get all the information there about terms, et cetera, and sign up to invest if you find it attractive. But thanks so much, Joe, for coming on the podcast and for giving us a little bit of an update on the single family home market.
You're welcome. Thank you.
Hope you enjoyed that interview. If you like learning about these private real estate opportunities, make sure you're signed up for our real estate newsletter. If you're not signed up for the White Coat Investor newsletter, make sure you're signed up for that. You can sign up for both of those at whitecoatinvestor.com/free-monthly-newsletter. And you can turn them on and off at will. We do not want to send you emails that you do not want to receive. So you can turn them off using the links at the bottom of every newsletter. There's no commitment here. Yes, we have ads in our newsletters. We're trying to run a for-profit business here, but the primary purpose of these is to educate you and to help you become financially literate, help you become financially successful. So make sure you check that out. You'll get a list of people, most of which I've invested with personally, who are currently partnered with White Coat Investor, as well as their latest deals, funds, syndications, whatever. With that newsletter, we send it out about once a month. All right, our next question comes from the email box. I'd like to contribute the maximum employer/profit sharing contribution to my solo 401k for 2021. I do my taxes in TurboTax, and I've calculated what my max contribution is going to be. I'd like to get this money into the market now, but I haven't submitted my taxes yet because my state won't start accepting returns for another couple of weeks. What would happen if after submitting my taxes get returned and I end up having made a mistake that results in me having over-contributed to my solo 401k? Can I recharacterize some of the 2021 contributions to 2022 contributions, or should I just wait to contribute until my tax return is submitted and accepted? What if I find out I screwed up my taxes and end up over-contributing for 2021? Can some portion of 2021 contributions be recharacterized as 2022 contributions? Yeah, the bottom line is they can. You just got to call up the 401k provider, and they can work with you. They'll either send you your money back or they'll apply it as a 2022 contribution. I've had that happen, I don't know how many times in the last decade, 2 or 3, 4 times maybe, for whatever reason, where it ended up being an over-contribution. That was the easiest way for them to fix it. They just said, we'll just make it a 2022 contribution. So no big deal. Technically, you're supposed to make that contribution before you submit your taxes. So I would not wait until your taxes are submitted and you got your refund back or whatever to do that. Just make the calculation, submit it, and if heaven forbid you screwed up your taxes and you got to redo it, then you have to redo it. Not that big of a deal. All right, our next question comes from Sangita off the speak pipe. Let's take a listen.
Hi, I converted my traditional 401k to traditional IRA, and then from traditional IRA within few days, maybe 8-10 days, I converted it into Roth. Do I have to fill up 8606 because I did not convert 401k traditional directly to Roth, but it went through my traditional IRA? Thank you.
Okay, if you're ever wondering if you have to file a tax form, go to the instructions for that form. So the instructions for Form 8606 in this case. And usually on the first or second page of those instructions, you will find a section the IRS puts together called Who Must File. And in the case of Form 8606, it says this: file Form 8606 if any of the following apply. And the first one is you made non-deductible contributions to a traditional IRA. Okay, that's not you. You received distributions from a traditional SEP or simple IRA in 2021, and your basis in these IRAs is more than 0. Okay, that's not you either. You and your spouse transferred all or part of their traditional SEP or simple IRA to the other spouse under a divorce agreement. That's not you. You converted an amount from a traditional SEP or simple IRA to a Roth IRA in 2021. That's you. That means you got to file. If you'd gone directly from the 401k, I don't think you would have had to. So by taking that step, by going into the traditional IRA and then converting, you're going to have to fill out this form as part of your tax return. Sorry. Hope that's helpful. All right. Hope you've enjoyed this episode today, talking about these 401k questions. 401ks can get surprisingly complicated. You know, I'm always amazed at all the angles you guys can come up with the questions you've got for me on this. But truthfully, it's a pleasure to answer them and to help you find what you're looking for. Our sponsor for this episode is studentloanadvice.com, where you'll receive a customized student loan plan using the principles of the white coat investor. Saves you hours of research and stress, and potentially saves you hundreds to thousands of dollars. The student loan consultant there can get you answers to all of your student loan questions, clarity about your financial future, and start you down the right path towards financial independence. Book a consult at studentloanadvice.com today. Make sure you're signed up for our newsletter. Thanks for those of you leaving us 5-star reviews and telling your friends about the podcast. Our most recent 5-star review came from someone who describes themselves as a faithful listener and lifelong learner. I very much look forward to listening to Dr. Dolly every week and often listen within hours of new episodes dropping. From growing in confidence about how to execute a backdoor Roth to considering marriage and relationships in personal finance, I learned something after each episode. Today's episode, 250 with Dr. Spath, reminded me to review and update beneficiaries with whatever accounts possible to avoid probate, something that can greatly impact access to funds should something happen to my husband or I. Thank you for today's reminder, and thank you for your excellent conversations, tips for financial well-being, and enjoyable podcast delivery. I look forward to each episode. It's very nice of you. Thanks for that great review. 5-star reviews help us spread this message to your colleagues. Keep your head up, your shoulders back. You've got this, and we can help. We'll see you next time on the White Coat Investor Podcast.
The hosts of the White Coat Investor Podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.